AT&T, Kevin Prendergast, Director of Wealth Management at the Retirement Network. Leland Smith. I'm recording this video on Sunday, March 6th, a bit later than usual. Apologize for the delay. My wife and now our son took a trip to get out of the cold here in Chicago during the time when I'd normally be recording these videos. So I'm going to get into the most recent minimum present value segment rates here in a moment, the January 2022 segment rates, some pretty significant changes that we'll want to monitor there. But first, I want to talk about what you're probably observing in your 401k retirement savings plan. Many of you are tilted towards large US stocks, and that's been a good thing really for the last 100 years, but certainly the last 10 plus. Being in that large cap US stock index has probably served you very well, but this calendar year, 2022, is off to a rough start. And largely in the headlines these days, of course, is the Russia-Ukraine conflict. That's a very complex situation with a wide dispersion of outcomes. It can be very difficult to predict how that might impact markets. But if you're watching this video, you're probably not retiring from AT&T tomorrow. So the good news is that when stocks decline, you are buying them every pay period on sale. You're buying something that you want to own long-term, that should serve you well long-term at a lower price. You're buying something on sale. So that is a good thing. Again, if you're watching this video, you're probably not retiring tomorrow. You're probably a few years away from retirement. So we're not so concerned about the market value of your stocks today, and that you're accumulating more shares of stock every pay period at these lower prices is a good thing. Again, the Russia-Ukraine situation is very complicated, very complex. The potential outcomes, the range of potential outcomes is wide, but the companies that you own in that large cap US stock index fund in particular are quite robust, quite resilient. And the entrepreneurial spirit in this country remains strong. So we're very confident that the best companies in the world will continue to perform well over the many years ahead. Okay, with that established, let's get into those segment rates as we normally do. And I should mention, by the way, sometimes when the market corrects, you want to review your holdings. Feel free to schedule an appointment with one of our advisors here through the website, theretirementnetwork.com. Go through this, get your free assessment button. And you can, of course, reply to the email containing this video as well. We do monitor that inbox. Let's get into the January 2022 segment rates. So pretty significant movement here. In our last video, we talked about how we expect the first segment to move higher because the first segment is most responsive to, most influenced by Federal Reserve policy. So when the Federal Reserve increases, that policy rate is going to impact the first segment most. We're also starting to see movement in the second and third segments now. Those segments were a little quieter last year. They're starting to move up quite a bit as well. Factors in the second and third segment include things like inflation, things like credit risk, meaning how risky is it when corporations borrow money? What is the likelihood of default? Those are additional factors baked into those longer term rates directly or indirectly that have led to those second and third segments increasing. So rates are still low by historical standards, but they are moving higher, which has a negative impact on pension lump sums. Again, pension lump sums are still relatively high by historical standards, but they're coming off the all-time highs that we've seen over the last year or two. Okay, so hopefully this is helpful. Again, if you'd like to schedule an appointment with one of our advisors, feel free to visit the website, reply to the email containing this video. We'd be happy to talk through your situation. All right, see you next month. Take care.